Hi, this is Jacob with PCE. One of the great things about an ESOP is that it gives all employees the opportunity to participate in ownership and share in the company's growth. But for senior executives who may already have high compensation, the ESOP benefit alone might not be enough to stay competitive with market pay. That's where a management incentive plan, or MIP, comes in, giving ESOP-owned companies a way to offer competitive, performance-based incentives tailored to senior leadership. MIPs typically focus on key executives and senior leaders, the individuals most directly responsible for executing strategy and creating shareholder value. These plans are intended to complement, not replace the ESOP benefit. They're equity-based, meaning the payout is tied to changes in company value, much like stock options in a traditional ownership structure. Most plans are built around two main objectives: performance and retention. Performance rewards measurable financial achievements, while retention encourages long-term commitment from key leaders. From there, most companies implement a structure that mirrors the value growth of their ESOP stock, which brings us to one of the most common incentive vehicles used in these plans: stock appreciation rights. Stock appreciation rights, or SARs, give recipients the right to receive the increase in value of a company's stock over a defined period. In other words, if the company grows and the stock value rises, participants share in that appreciation, without ever owning the actual shares. This structure fits ESOP companies particularly well for a few reasons. Once the SAR pool is created during the ESOP transaction, no new shares need to be issued, which avoids dilution and ownership complications. Because ESOP valuations are updated annually, SARs naturally tie directly to the same measure of value growth of the ESOP. In an 100% S-Corp ESOP, it allows the preservation of a full tax benefits, as SARs are not considered a second class of stock. Of course, these plans come with considerations, like managing the company's future cash obligations and understanding how the plan may affect ESOP value. But when designed thoughtfully, SARs can be a powerful alignment tool. Here's a simple example of how SARs work. Manager A is awarded SARs at a strike price of $2. The company grows, and when the SARs vest, the company is worth $9. This is the exercise price. Each SARs awarded to Manager A is worth the accretion of value between the strike price and the exercise price, in this case, $7. From a tax standpoint, SARs are generally tax deductible to the company when they're paid out, meaning SARs are settled in cash and treated as compensation. The company records a deduction equal to the amount paid to the participant. For the recipient, the payout is treated as ordinary income, not capital gains. The value they received is taxed just like wages in that year, just simply a compensation right tied to the company's value appreciation. This structure makes SARs relatively straightforward. They're deductible to the company, they're ordinary income to the participant, and there's no changes to ESOP ownership or shareholder status. When implementing a management incentive plan, balance is key. A strong plan blends performance-based incentives, which reward leaders for driving measurable value, with retention-based incentives, which help keep key managers engaged over the long term. Leaning too heavily in one direction can weaken the plan's impact, so combining both creates a more stable and effective incentive structure. When designing the plan, it's important to make sure the overall size of the incentive pool is appropriate for your company. This typically starts by modeling the total expected benefit based on assumptions about company growth, value changes, and vesting outcomes. Once you establish this total pool, you then allocate the expected value across your SAR recipients. This allocation is usually based on factors such as individual strategic importance, existing compensation structure, and their role in driving long-term performance. The goal is to ensure that the combined awards stay within the company's financial capacity while still providing meaningful upside for each participant. Another best practice is building flexibility into the design. Every ESOP-owned company is different, so the MIP shouldn't be one size fits all. You can adjust elements such as award sizing, vesting schedules, or the performance criteria, such as stock price growth. Designing these components thoughtfully ensures the plan reflects the company's goals and stage of growth. It's also smart to leave room for future grants, so the plan can evolve with the business, whether that means bringing in new management or executives, promoting internal talent, or refreshing existing awards over time. This dry powder keeps the MIP sustainable, scalable, and aligned with the company's long-term strategy. To wrap up, management incentive plans are an essential part of keeping leadership motivated and aligned in the ESOP-owned company. A well-designed plan maintains competitive executive compensation, rewards measurable value creation, and strengthens retention and long-term alignment with ESOP participants. Ultimately, the MIP motivates the management team to grow the company and share in its success, with the remaining employee owners benefiting directly from the value that growth creates, aligning everyone around the company's long-term success. If you'd like to explore what a well-designed management incentive plan could look like for your company, connect with us. At PCE, we're here to help.